Hello, good evening, everyone. I hope you're all well and in good health, keeping safe. Tonight, we're just going to, tonight is not a formal uh, presentation per se. I'm just going to add a bit more information to ETFs that from what we've known already about ETFs. So I'm just going to add some more information about it. And it's really more question and answer session and comments and sharing amongst each other. So it could end up being a very short session or a very long session, depending on you guys and questions and comments and feedback regarding investment in general and also ETFs. So I just wanted to highlight that. So I'm not going to be going into great detail in terms of the presentation. So we're just going to have a brief chat just to add some more to ETFs that we already know, and then just be question and answers and any interesting comments or feedback or opinion anyone has on the markets or interesting things they want to share with us regarding the markets. Okay, I mean, as we all know with ETFs, exchange traded funds, it's just another way of investing in the financial markets. So obviously, the number one thing you want to do is do your proper fundamental analysis. You know, as we know, once you've done your fundamental analysis, that is just a question of you looking for a financial instrument that will help you achieve your investment objective. So, for example, if you've done your fundamental analysis and you've analyzed the country you want to invest in and the sectors or industries you want to invest in, then you just then look for an index fund or an exchange traded fund or stocks and shares or something in that nature that would help you sort of track that country, sector or industry. So that's really what exchange, not exchange traded funds. That's what investing is all about, really. That's what it is really. So I think that's really where things like exchange traded funds now sort of help you in that way. They sort of help you because, they help you. So for example, if you've decided that you want to invest in a country, let's say for Indonesia, I don't know why I always keep using Indonesia as an example. But anyway, if you want to invest in somewhere like Indonesia, you can just find an index fund that tracks Indonesia or a mutual fund that tracks Indonesia or an exchange traded fund that tracks Indonesia. Then if you want to invest in a sector in Indonesia, like the agricultural sector, the service sector, or in general, if you want to invest in like the technology sector, the real estate, commodities, you can get ETFs that can help you track those different sectors or commodities. So that's the beauty of exchange traded funds. They give you the flexibility without the stress. As we all know, if you want to invest in an individual company, you need to do a lot of analysis about that company, know a lot about that company. And of course, you're just buying one company share or one stocks and share in a company. Whereas with index funds or ETFs, you have a basket of companies or securities. So this sort of helps you spread your risk, so to speak. So that's what ETFs, index funds, they help you do. So for example, if you want to invest in the technology sector, instead of you just buying maybe Amazon or Google, you could just buy an ETF that tracks the whole sector. Then that way you have a nice spread of different companies within that sector. So that's it, the advantages of using exchange traded funds. to do that. Okay, so let's look a bit more on this, what this, let me bring up the presentation. Just a few more things that we can quickly add to ETFs. Like we said, ETFs, the reason why they're called exchange traded funds is because it's just like any other fund, but it is traded on the stock exchange like stock and shares. So that's why it's called exchange traded funds, because it's a fund where, like I say, it's the fund manager it's a fund manager managing it. It's a fund that lots of people can put in money in, and then it's a fund that invests in different securities within that fund. But the big advantage is that it is actually traded like stocks and shares on a daily basis during the stock exchange hours on a stock exchange. So that's why you have the word exchange, meaning stock exchange traded fund. So it's a fund that is traded on the stock exchange. You have what we call also inverse ETFs, or exchange traded notes. Basically, with these inverse ETFs, you can short sell the market. So those who are used to trading, obviously, if you're not used to trading, you just ignore this. But if you're used to trading, as a trader, you can either buy and profit with the market going up, or you can sell and profit with the market falling. So if you want to profit with the market falling and do what you call short selling, you can buy what you call inverse ETFs, which are sometimes called exchange traded notes. So that's where you use to short sell the market. But like I said, if you're not a trader, just ignore that, because short selling, there's some risk involved. Of course, if you read the market wrong and the market doesn't fall, then you could lose money. And obviously, because if you're lucky and you invest in an ETF that tracks a group of companies that pay dividends, then you could also earn dividends on your ETFs, actually. Obviously, if you're unlucky and you invest in an ETF that most of the companies there don't pay dividends, then you won't earn dividends. So yes, there's also the possibility of earning dividend payments on your ETFs. We also have what we call the new and advanced versions of ETFs, which have been developed over the years. Because obviously when ETFs started, which is what you call this traditional physical ETF. With the traditional physical ETF, it's a fund that is actually the underlying securities, is actually buying underlying securities reflecting the index is tracking or the sector is tracking. So for example, if you have an ETF tracking the FTSE, for a traditional physical ETF tracking the FTSE, it would then have companies within that FTSE 100 in that fund. So you'll be actually invested in those companies listed on the FTSE 100. If you have an ETF tracking the technology sector, it would actually have investments in those companies that are in that technology sector. But with synthetic ETFs, they don't necessarily have to. So with synthetic ETFs, they don't actually have the underlying security. So if you have a synthetic ETF, for example, tracking the FTSE, if you have a synthetic ETF tracking the FTSE 100, for example, you might not have any security. It might not be invested in any security in the FTSE 100. Might just be finding a very, what we call financial engineering, finding that's actually why the word synthetic is there, that is not real. You might just find another, innovative way to mirror the performance of the FTSE or whatever index is tracking. So one way you can do this is use what we call swaps with the synthetic ETFs. They use derivatives like swaps. And with swaps, one has to be careful because it's quite dangerous. because like I said, they're not actually buying anything in the FTSE. So if you have a synthetic ETF tracking the FTSE, for example, they might not buy any of the companies in the FTSE. They might just go to a bank and tell the bank, say, okay, can we have a contract whereby we give you some money from the investors, you try, and let's just say they hope the FTSE might make a return of maybe 15% that year. Then the bank will say, okay, we'll try and, with our own willing and dealing, we might try and match that 15% of the FTSE. And of course, if they do better than that, they will keep the extra profit. But of course, if they do worse than that, then there might be a problem. So this is where you have what they call the counterparty risk. Because you might, if you invest in a synthetic ETF, you have to be then aware that you're not really directly investing in that market. You're investing in another company, which is the counterparty, usually a bank, and hoping that bank gives you the same result as the index you're tracking. So there is some risk using synthetic ETFs and swaps, because you have that counterparty risk. If they don't perform well, you might get less than you expected. But synthetic ETFs, they tend to be used these days as a gateway for investors to gain exposure in markets that are hard to access. So that's usually where they use synthetic ETFs. So let me just use Nigeria as an example. So obviously, you might not, it's very difficult for you in the UK or anywhere outside Nigeria to access the Nigerian stock market. So if you want to buy, Zenith shares or, ICO or GT Bank shares from the UK, it's difficult to get a broker in the UK that will be able to buy you those shares. So you have to open a brokerage account in Nigeria if you want to access those shares or access the Nigerian stock market in general. So what a synthetic ETF can then do is that because people can't access the Nigerian market in the UK, someone can then create a synthetic ETF that will sort of tell you that, okay, we know you can't access the Nigerian market, but we'll give you this fund that will try and mirror the return of the Nigerian market. So that's sort of where synthetic ETFs come in. Because as we all know, if you've been investing for a while now, you know that there's some countries like Israel, some other countries where you might want to invest in, but getting access to those countries might not be as easy to get access there. But this is where synthetic ETFs come in. They might give you exposure from those markets that are hard to access, but you need to be aware that they're not actually holding the actual securities. They tend to do financial engineering and swaps, and they have that counterparty risk, where it's a bank usually that is just trying to sort of mirror the returns of that country without actually owning the assets in that country. Now, because of this synthetic ETFs, this is why the EU have this rule now just to protect investors. So there's this thing called the UCITS, which you will see on some ETFs. You see this UCITS, which just stands for Undertakings for Collective Investment in Transferable Securities. So it's just an EU directive to protect investors and to regulate the fund providers. So that's something that sometimes, if you find that an ETF is not actually holding the securities of the underlying index, then you want to see if they're UCITS compliant. But the key in this rule, obviously there's a lot of rules and a lot of undertakings before they can certify you with the UCITS certificate. But the key one there is that they want to make sure that the fund's exposure to counterparties may not exceed a total of 10% of the fund's net asset value. So basically, you know, you want to make sure that, you know, even if that fund is giving money to a counterparty to try and mirror the exchange, they want to make sure that, you know, it's not more than 10% of the fund's net asset value. So they know that, you know, basically you're not giving them all the money and then they lose all your money. So it's a way of just protecting investors without counterparty risk. And this is very important when it comes to investing in synthetic ETFs to make sure that they're compliant with the UCITS rule. Okay, and then obviously you have the ETF. We're going to go through this website. I believe I've shared this website with all of you on the platform, so you should all have this website. But again, if you're looking for ETFs, you can just Google, you know, there's Hargreaves Lansdown, obviously, there's this website, there's Google. Like I said, you first have to know what you want to invest in first. So I think that's the first decision, which is actually the theme on the platform this month. You know, looking through the ETFs that I'm currently looking at buying and currently actually buying. But like I said, the first thing is that it's not looking at ETFs first. ETFs is the last thing you look at. What you want to decide first is which country do you want to invest in? Which sector do you want to invest in? Which industry do you want to invest in? Once you've made that decision from your fundamental analysis, then you start looking for ETFs to help you achieve that objective. And I think I've shared about 2 of the ETFs I bought recently on the platform. But this is where this ETFDB.com comes in, because you can see it helps you by category. So if you find a country where you can't find index funds to track that country, you can then look for ETFs by geography to see if you can find an ETF. If you can't find a fund, an index fund, maybe you can find an ETF. So you can find ETFs that track different countries here. Then of course you can see ETF by category. So again, if you know what you want to track, so you can see here you've got, if you want to track the bond market, you've got corporate bonds, emerging market bonds, government bonds. So like I say, you first need to decide what you want to track before you start looking for ETFs. Of course, commodities, you've got agricultural commodities in general, metals, oil and gas, precious metals, then of course currency, which you can track. And then of course equities, which is stocks and shares, so China, consumer staples, emerging markets, energy, Europe, financials, blah, 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 global, health and biotech. So like I say, you first need to know what you want to track. And then from there, you then start looking for the ETFs you want to buy. Okay, so like I said, this is more or less a question and answer session. So I'm not here to go into a formal presentation. So if you have any questions, you can either send it through the chat box or you can raise your hand and ask the question. Oh, before I forget to, I hope I remember, I should remember. I'm just going to show you all, I think this is because of Barbara, show you how you can place stops when you buy your ETFs or buy your stocks and shares, how you can place stops and sort of lock in your profit when you're profitable. Okay, let me just go through these questions in the question box. Please, can you explain the difference between ETFs and an ETP? There isn't much difference between them, really. ETF, as you know, is exchange-traded funds, and ETP is exchange-traded products. But more or less, they're the same thing. Exchange-traded funds and exchange-traded products, more or less the same thing. I guess the difference will really become which particular exchange-traded fund or exchange-traded product you're buying. So again, it is actually a good example. So for example, if you're buying exchange-traded funds or products with currencies, some of these currencies you could actually be short in the market. And then if you're short in the market with some of these currencies, you're then doing inverse ETF, like I said before. But by and large, the terminologies are more or less the same, but it really then comes down to the exact ETF or ETP you're buying, because that exact one might then determine whether you're going against the market, you're shorting the market, whether it's a synthetic ETF, whether you're doing hedging with the market. So you can see you have this alternative ETFs where you hedge and you can hedge the market. So, and then you can see these are the inverse ones, the inverse equities where you try and short the market. So yes, but by and large, they're more or less the same. ETFs and ETP. ETP is exchange traded product. They're basically the same in terms of their funds that are traded on the stock exchange. So they're traded like stocks and shares. They can track different sectors and all that. But I think the real difference comes into exactly which one you're choosing to invest in. Are you using a leveraged one? Are you using an invest ETF or ETP? Are you using a synthetic one? So when you now come down to the actual ETF itself, that's where the real difference comes in. Are you doing a physical traditional ETF where, for example, let's see, this is my watch list for ETFs. I'm actually thinking of buying this one tomorrow, SKYP. I'm going to put it on the platform tomorrow, SKYP. Okay. So you can see this is a traditional ETF, because when you look at this, of course, you can see they don't pay dividends. So this one doesn't pay dividends. But usually when I buy ETFs, I'm not really worried about dividend. It's more the stocks and shares. Of course, you can see the objective, what they're trying to do. It's the cloud computing they're trying to track. So you can read about what this ETF is actually tracking. You can see they've got the UCITS. It says, is the product compliant with UCITS regulations? It says yes. But this is what I want to show you. It's just the fact that, they are actually, the securities within this ETF is the actual companies themselves. We've got Zoom, Twilio, Nvidia, Apple, Alphabet, which is Google, Alibaba, Amazon, Microsoft. So, these are their top 10 exposures. So this is not this is a traditional or a physical ETF whereby you've got, exposure to all these companies within this ETF. So this is not a synthetic ETF, and it's listed on the London Stock Exchange. So I think, like I say, yes, that's where you really come down to the real difference between ETFs that you buy. Is it physical or is it traditional, whereby it's the actual securities itself, or is it synthetic, whereby they're just trying to mirror an exchange from using a counterparty? Bimbola, good evening all. Most ETFs don't pay dividends. I've not found any yet. Yeah. Likewise, most of them don't. But yeah, some of them do. But yeah, even me too. Most of the ones I've bought, most of the ETFs I've bought don't pay dividends. But like I said, that's not a game changer for me when I'm buying ETFs. Yombo, apart from the UCITS, how can one identify synthetic ETFs? Well, like as you can see, the UCITS would not help you identify whether it's a synthetic ETF. Like I said, there are other rules and regulations with the UCITS. It's not. I just highlighted the one about them not using more than 10% of the net asset value and risking it with a counterparty. But there are other rules involved to protect investors. So basically, once you have this UCITS, it sort of reassures investors that you're well regulated and you're under a watchful gaze and you're doing things the proper way. But yes, that will not tell you whether it's a synthetic ETF or not. So just like I've done, you will have to check for yourself and see, what are the securities that they're trading with. So what are the securities? What sectors are they tracking? And so if they don't have that there, so yes, you basically just have to look at the qualities, not the qualities, the features of you can see here, this is actually put here as also as ETP, exchange traded products. So that's why I said, ETFs and ETP is really more or less the same thing. But yes, you have to just look at the full details of what you're buying. So you can see here, it tells you the replication method is stocks full replication. It's an ETF. Securities lending, no. So there's no loan or lending. Number of holdings, 50. So they have 50 securities that they have in this fund. And of course, they've shown you the top 10 securities they have in that fund. So I think it's just you. Obviously, before you buy an ETF, you need to know the full details of what you're buying. Everything you can about what that ETF is all about and who they are. Let me see if we can just choose another one at random. Oh, by the way, if you want to just get the full list of ETFs on Hargreaves Lansdown, you go to shares. So under shares, you just type in ETF. Just ETF and then enter. Excuse me. So that's one way you can get the full list of ETFs on Hargreaves Lansdown. You just type in ETF and enter. And you can see you've got 16 pages of ETFs. So you've got 16 pages of ETFs listed on the Hargreaves Lansdown website. So you can see they've got quite a lot of them. Okay, I'm just trying to see. I'm suspecting an inverse ETF will be more like a synthetic ETF. You're going to short. So I'm trying to look for an inverse ETF. Okay. So you can see this short. So this is I don't know what is short in here, but this is something that is going short on the market. Let's see. I wonder what's it short in. So you can see, so I mean, I suspected that's what will happen because when you have, when you're shorting the market, it's really, shorting the market is really a derivative. That in itself is a derivative because it's a financial engineering way to profit from the market falling. So you can see this one, it now tells you here the replication method is by swaps. So you can see there, they've told you this is done by swaps. So this tells you that this is a synthetic ETF. So you can see they only have one holding, obviously, just this daily swap they have. So this tells you straight away that that's a synthetic ETF because it's dealing with swaps, not with stock replication like you saw with the other ETF I showed you. So again, like I said, it's just making sure you check the details of the ETF you're buying, and you can see it's compliant with the UCITS regulations. So this is where this is more relevant, because you now know that with this swap, because the UCITS compliant, there's only 10% of the net asset value that they will expose with the counterparty. Going short in the market itself, that already tells you it's a derivative again, that in itself. But so you can see that with ETFs, you can actually short the market. But you see there are 16 pages. Let me just go through 2 more pages and I'll stop, but that's for you to go and play with. You can see this is Saudi Arabia. Interesting. Bloomberg commodity. Yeah. Trying to see if we can see some for the currencies. But like I say, yeah, this is something you can play with in your own time. But like I say, it's first you deciding what you invest in. So so it's not you going through this list and just picking ETFs at random. You first decide what country, sector, industry you want to track, and then look for this ETF to help you track that industry, sector, or country. Not come through this list and just pick ETFs at random. Anyway, so you can see they've got 16 pages of ETF. So if I say just type in, go to shares, type in ETF, and then enter, and then that full list will come up. Abimbola, do you want to add to your question?
Well, I was just going to say on the ETFs, on the synthetic ETFs, what I saw the swaps that you've just alluded to,
Yeah.
and I didn't understand that, so I actually spoke to HL to ask them to explain what that meant. And they sort of explained along the lines that you did, but they also said that the exposure. So I was looking for an ETF that was tracking gold mining companies, but when I looked at the exposure, it had nothing to do with gold mining companies at all. And so I needed them to explain that to me, and they sort of explained along the lines that you did, that it's a swap, so it's not actually tracking the companies that I was looking for. So
Exactly.
that's one way that you can also tell, is that if you look at the exposure and it's nothing like the companies that you're looking for, then it's most likely a synthetic ETF. And then again, it will actually say whether it's a swap or whether it's a replica.
Yes, well done. So at least you've got that personal experience of that. So yes, this is some of the gold ETFs. Gold mining fund, gold mining, gold miners. Physical gold.
It's actually one of those ones that I was looking at. I think it's the gold, either the gold miners or the gold mining.
Not the physical one.
No, it wasn't the physical one.
Did you want the physical one?
I didn't know the difference between the physical one and the gold miners, to be honest, so I just left them.
Well, gold miners are people who mine gold. Well, do you just want the one that's been minted?
No, I was actually looking at the companies, the gold mining companies, but I didn't know what the difference between them and the actual physical was. So I know what gold mining companies are, but I don't know what.
Well, the physical gold itself is just a gold, so no one cares who mined it. You're just looking at the gold, the minted gold itself. You know, the gold you see in pictures, the yellow bar, the gold bars. So you're just tracking the price of gold itself, just the physical gold itself. As to the mining companies who are actually mining it, I think gold is a bit like agriculture. Well, they are all in the commodity sector, in that there's a value chain. So you have artisanal miners who just pick gold from the surface. You have those who go deep down and go and dig from the gold in the depths of the earth. And then they sell it on to the refinery, and the refineries refine the gold, and then that's the end product. So there's a value chain. So it's the same as coffee, which is actually what I'm doing in Rwanda as a coffee farmer. So you have the farmers who farm the coffee, then the cherries. When they get the cherries, they give it to somebody else who will wash it. Then the one who washes it will give it to someone else who will mill it. The one who mills it will give it to someone else who will roast it. Then there's someone else who will package it. And then by the time you get the coffee you see in the shelf, it's gone through 4 or 5 different people. So the question is, what are you investing in that value chain?
It's a good question, because I didn't know which is the most beneficial to invest in.
Actually, that's a very good question, and it's actually a good thing you brought that up, because this is why it's very important, like I said earlier, and actually that's a very good example you just brought up, just to highlight what I said earlier. This is why I said earlier that, you know, the homework is first to do what do you want to invest in before you look at the ETF. So that's what I was saying earlier, and that's what I meant by that, is that you first need to know, you know, what country, what sector, and of course, when it comes to commodities, where along the value chain you want to. I mean, cocoa is a good example, and chocolate. I'm sure everybody knows about that. So you know, chocolate comes from cocoa.
Mm-hmm.
But you know, there's a big difference between investing in a chocolate company and a cocoa farm. So although they're all one and the same, the chocolate is the end product from the cocoa. But the cocoa, if you're invested in cocoa farming, then you need to know which country, because obviously I think Ivory Coast, I don't know, I'm not a commodity expert, but I know Ivory Coast at a time were the top cocoa producers in the world for coffee, for chocolate. I don't know if that's still the case. I'm not a commodity guy. So if you want to do that, you have to do your research. But obviously, if you're going to now invest in the cocoa side of that commodity of the value chain of the chocolate, then you need to know the seasons. Obviously, with Ivory Coast, they had turmoil in the country, so there was problems that was affecting the cocoa harvest and, of course, cocoa prices because of the troubles that was going on in the country. So obviously, if you are investing in that side of the value chain, you need to be aware of all that. And if you're now investing in the company at the end of the value chain, you need to know which are the top chocolate companies. So again, this is why the homework is the most important bit first, because once you've done the homework, then it's just you then deciding which part of the business you want to invest in. I hope that helps, Abibola.
Yeah, very much so. I think I hadn't done enough homework, if I'm honest.
Okay, that's okay.
Because I certainly wasn't looking at the whole value chain. I hadn't gone into that depth. So, but I didn't buy it anyway because I didn't understand it, so I left it.
But that's a very good thing you did. I think I also highlight what you did. That's very good, because that's exactly what Warren Buffett too does. Don't buy anything you don't understand it. And I'm glad you did that. It's always safety first. If you don't know, if you can't understand what you're buying or the sector you want to buy, it's best not to buy. And that's exactly what Warren Buffett does. That's why it took him a very long time before he bought into technology stocks, because he didn't understand that sector. So you did very well. You're like Warren Buffett.
Yeah, without the finance.
Well, at least you've got the right attitude. Don't buy what you don't know, which is where people make mistakes and lose money.
Thanks.
Pleasure. Bola, do you have a question?
Yes, I do. And I want speaker, do forgive me. I'm driving, but I'm using my hands free, so do forgive me. My question is similar to Bola's own, because I did my fundamental analysis on the UK. Yeah. And one area that was of interest to me was actually the defense. One of the key industries within the UK is defense and British Aero Systems. And I thought, ooh, I mean, it's not an area that I know a lot about, but it was an area that interested me. And so I read up a bit more. And I thought, yeah, I'd like to buy an ETF that tracks companies that deal with defense, preferably not ammunition, but defense. Yes, I was happy with that. And I found out that all the companies that I could find were all based on the American Stock Exchange, nothing on Hargreaves Lansdown. And the only one that I could find that was close to it was a company it was an ETF that said something about a granite defense something. So when I read up on it, it was saying something along the lines that it would buy part of the company. What it would do, it aimed to make 3 times whatever amount the company that it was. Anyway, the long and short of it, I didn't understand it. So just like Bola, I thought this is too good to be true. I don't understand this company, this ETF. I'm not touching it. So
Well,
basically,
that actually sounds
sorry.
like that's definitely a synthetic ETF.
Right,
So that's a
right.
synthetic ETF because you get. Let me actually go back to shares. Let me go to ETF and then enter. So you might. There are certain key things that an ETF will say that you'll be able to know straight away is synthetic. Because if it's a traditional physical ETF, they will be tracking the companies in that index. And when you're tracking a company, it's one to one, if you know what I mean.
Mm.
So if Amazon goes up by 1%, then the Amazon, their own portfolio too will go up by 1%.
Exactly.
That's what you call a physical traditional ETF. Anything other than that is now synthetic.
Yeah.
Once you
It was
now
saying
start saying times 3
times more.
Oh yeah.
It was saying it was saying 3 times more. And I thought, you know what? No, I'm not really interested in that. And I couldn't see my companies. I was like, when I want to buy an ETF, I want to see all the companies listed, and I want to see the countries that they are represented to make sure that the country, even if it's not 100% my country, let me at least see a fair amount of the countries that I'm in, of the country that I've actually done my analysis on, and I didn't see that. But what I did do, I went away and I read up on British Aero Systems, and they've just got a new contract and So it looks as though they're doing extremely well, and I bought some stock. So I went direct to the company on this occasion.
Yeah, this is, I can see your granite here. So you can see that's what they have here, 3 times. In fact, you can see they already say going long, and of course they're going short. 3 times short on Barclays, 3 times short on BP. So yeah, once you start saying stuff like that, that straight away tells you it's a synthetic ETF. They're doing this now. You're now into the realm of financial engineering and swaps and derivatives. In fact, that's why some of them are not even available online, because they're sort of high risk.
Yes.
Hagris Lanza might want to know that are you sure you know what you're doing before you buy it? Kind of thing.
Well, I like Bola did. I looked at it and I thought, this doesn't seem to be what I'm looking for. And yeah, BAE. Funny enough, the stock's gone up today. So I thought to myself, you know what? I no regrets there.
Yeah, I actually bought BAE during the COVID crisis.
Oh, okay. So I'm in good company.
No, but it's just interesting because you find that that's the beauty about investing. You know, the logical ideas is the same with anybody who make. That's why I always tell people that you're really no different between you and Warren Buffett. He just makes simple logical ideas. Yeah, we all know, the defense is a good place. There's certain things that you don't need to be Einstein to figure out that this is a good place to invest.
And it's going up sorry to interrupt you, and it's going up 0.5% every year, I believe, for the next 5 or 6 years. In terms of the money that they get from the government, the investment in it, 0.5%. I thought, okay, so yeah. So at least for the next 5 years, they are likely to be on an upward trend.
I found out, this is why I say it's interesting to watch very interesting programs and interesting documentaries. There's a documentary I watched once where they were interviewing this guy, and he was saying that there are certain contracts you can get with the Pentagon and the US Army. He has a security contract with the US for 100 years.
Wow.
To guard one facility in America, one of their military facilities. So, that kind of a company, okay, that's his guaranteed money for 100 years.
Yeah.
Anyway, so well done.
Thank you.
Actually, it's a good thing all this is coming up, because I think that's actually one of the reasons why we're having this question and answer session, just to highlight all these subtle things when it comes to investing in some of these products. Let me go back to the question box. Bola, okay. Oh yeah, I've spoken to Bola. That's Egonosum. Do I have to set my stop loss and take profit when investing in ETFs? Okay. Yes. I was going to talk to you guys about setting stop losses and all that on the platform. It was actually Barbara that made me think about that. We're on Buffet, Barbara. So let me bring up the whiteboard first. So don't complicate it. So let's say, for example, you bought a share at, let's say, 200 pence, because you tend to set up your stops and or whatever in pence. So let's say you bought your stock at 200 pence per share. Per share. Oh. So this is what you bought it for. Okay. So obviously, if this let me start again. I forgot I'm not very good at math. Let me make it simple for myself. So let's say let's say you bought it at 100 pence per share. 100 pence per share. Okay. So if it drops to 50 pence, you've lost 50%. Isn't that right? So that's straightforward. You bought it at 100 pence per share. If it drops to 50 pence, you've lost 50%. If it goes up to 200 pence per share, you've made 100% profit. Okay, so that's pretty straightforward. So usually if you want to automatically set your stop and profit limit, obviously you need to take into account the £11.95 transaction fee when you buy, and then the £11.95 transaction fee when you sell. If you want to be quite on the money, you can bring out your calculators and do that. Anyway, but let's just keep it simple. So if you buy at 100 pence per share, if the stock drops to 50 pence per share, you've lost 50%. And if it goes up to 200 pence per share, you've made 100% gain. So when you buy, you can actually set a stop loss that if it drops to 50 pence, you want to sell. And if it goes to 200 pence, you want to buy and take your 100% profit. So I don't set the 100% stop, because sometimes I know these stocks can go up very, very high. So what I do is that, yes, if you want, you can set the 50p stop loss, or the 50% stop loss. But what I tend to do is that if I buy 100 pence and then it then goes up to 200, like I showed you here, then I will place a stop at 150 pence per share. So I bought at 100, I'll now place my stop at 150. So that way, at least I've locked in 50% profit. So the stop is at 50p, and the market is currently, and the stop is at 150, but the market is currently at 200. So obviously, if it keeps going up, I'm still there. But if it falls back down, if something catastrophic happens and it falls, at least I'll be taken out and I'll still make a 50% profit. Let me go all the way. So what I do is that I buy at 100. If it goes to 200, I place a stop loss at 150. If the market now goes to 250, I move my stop to 200. If it goes to 300, I move my stop to 250, and I just keep doing that. So let me go onto the platform and show you what I'm talking about. Let me log in. Again, I might be a bit quiet as I log in. Let me get my login details. So just bear with me while I am talking slowly, because I'm, number one, looking for my login details, and then I'm going to type it in. Obviously, any problems, you can always call Hargreaves Lansdown. Don't forget, they're your brokers. They're there to help you. Getting there. Almost there. Okay, right. I am there. Right, let's see. Let's make this a bit bigger. Okay. So, let's see. Okay, let's go for this ETF. Although the principle is the same, regardless of what stock or ETF you're going for. The principles are the same. So I'll go with this X Trackers that's got up 171%. You can see here it's currently 757.51 pence per share. That's what it currently is. So if you want to place a stop, you just click on this green arrow. You click on this green arrow, and that'll bring up the next page. So you click on the green arrow. Just wait while the thing rolls. Okay. And then you can see this is where the page comes up. Obviously, the stock market is closed now, but you can still place it. So you can see where it says stops and limit orders. So we'll choose that. So with the stops and limit orders, it's tell you, do you want buy limits, but obviously we want stop loss. Number of units, I currently hold 17 units, so I'll say 17. And then this is what I said about the price, the pence. I think it's currently 757. So I could just say 527. Oh, actually, it's showing there. The sell price is 12,078. I'm just doing this quickly, but obviously, if you're doing this, you really need to find out how much you bought it per pence, and then work it out properly. But I'm just showing you where you can go to do it, and then you just have to do the math. Like I say, I'm not very good at math. Let's see, divided by 2. Let's say it's okay, 66039. Okay, there you go. So I've just put it at 50% below the current sell price. And you know the sell price is now at with this sell price, I'm now making a profit of 171% profit. So if I put my stop at this level, that means if it drops 50% from that means if it drops to 120% profit, it would take me out, and I'll still make 120% profit. Now, the other thing that it does expire after 90 days. So in 90 days, Hargreaves Lansdown will send you an email. So on the 3rd of March next year, it will send an email to say it has expired. So if the market hasn't taken me out by then, I would then have to come and place it again. But this is something you can do sometimes when you're when the profit has gone up and you just want to ride that stock for as much as you want, as much as you can get out of it, you can add stop losses to at least protect some of your profit in case the market falls sharply for all of a sudden. And of course, once you're happy with that, you just click place stop loss and you're done. So that's really how you can place a stop on the platform. Aussie, yeah, unfortunately, actually, you can call Hargreaves Lansdown Aussie to see if you can change the 90 days. I've never tried calling them before. I guess because I trade on a daily basis. So giving me 3 months and keeping my stop for 3 months is a luxury for someone like me who changes my stop loss on a daily basis as a day trader. So I've never actually called them to see if they could keep that stop for longer than 90 days. I know that it's maximum of 90 days if you apply it yourself on the platform, but whether you can have it for longer than 90 days, I have never called them to find out. So that might be something to call them about, Aussie, and see if you can make it permanent or keep it going till whenever. But yes, it's not a question I've actually asked them before.
Sorry, Remy, can I just check? Did you say you add your the sell price to the stop loss sort of price that you the price that you would sell? Sorry, the stop loss price that you would set.
Like I said, keep it simple. Don't complicate it. Just keep it. Like I said, what price did you buy your stock? Like I said, I'm terrible at maths, so don't get confused with my maths there. That's why I said, just keep it simple. If you bought your stock at 100p per share, then if it goes up to 200p per share, you made 100%. Isn't that right? Hello? What was that?
Yeah, sorry. Yeah.
Okay. So so number one, you need to find out exactly at what price did you buy that share in pence per share. Because like I say, if you buy it at 100p and it goes up to 200, you made 100% profit. So if you place your stop at 150 pence per share, then you've locked in on at least 50% of your profit. Isn't that right?
Yes.
Yeah. So I'm just saying that I'm just showing you, and I've showed you the way you can do it on the platform. But when it actually comes to your own share, you need to obviously go and get the exact 200.59 pence, and you do the math. Like I said, that is where you lose me with maths. It gets, you have to bring out calculators. But yes, you then have to find out what exact price did you buy that share in pence per share. And luckily on the Hargreaves Lansdown, it shows you the percentage return anyway, so it makes it easy for you. So if you made 100% plus, it then makes it easy for you to just, okay, at what price did I buy it? Of course, you can even make it simple, because if you bought it at, let's say you bought it at 43.656, you can just multiply that by 2. Let me bring my calculator out. So if you multiply that by 2, that's 436.56 times 2. So that's 8873.12. So if you bought it at this price, 436.56, if it goes up to 873.12, you made 100% profit. So you now know that if you want to lock in 50%, it would just be this divided by, it would just be half of this, your 43, really. Okay, let me do that. So that'll be 43, that's why I said you have to do the math yourself. 43.56 divided by 2, so that's 218. So for 436.56 divided by 2 is 218.28. So you add that to the 436.56. So that's plus 436.56. So that's 654.84. So that would now be my new stop loss. So it'll be 654.84. 854.84. So I bought at 436.56. It's gone up to 873.12, which is 100% profit. So to lock in 50%, I'll put that price at 654.84. But like I said, this is where you need to bring out your calculator and oh, sorry, I'd paused the screen when I was doing that. But yeah, I think you just have to bring out your calculator and work out, do the math, really. That's why I first kept it simple with 100 pence. You know, you buy at 100 pence per share, it goes up to 200 pence per share, you get 100% profit, you can now move your stop to 150 pence per share to lock in 50%. And then if it goes up further, you just keep moving your stop. Again, obviously you can play around with it. You know, you don't have to do exactly what I'm doing, but I'm just showing you that yes, there's that feature on the platform to place stops, to place profit limits. So we have those features there to help you with your with the ETFs and the stocks and shares you buy. I hope that made sense. I was getting myself really mixed up with my maths. So yes, that question got me from Egonosum's question. Do I have to set my stop loss and take profit when investing in ETFs? So yes, you can do. So you can set it, or you can do it manually. But it might be a good idea to set it, because obviously markets can be quite volatile. What are the fundamental analysis one can carry out before investing in ETFs? Like I said, the fundamental analysis you carry out before investing in ETFs is really the same fundamental analysis you carry out when you're investing with stocks and shares. You need to know, and I think we already had some examples already today when we're talking about the gold and all that. Because yes, you need to first know about the country you're investing in. You need to know about the sector you're investing in. And like I said, that's the most important part. The ETF itself is a very easy part. But you need to know why you invest in that country, why you invest in that sector, what are the features of that sector before you then invest in that. So once you've now found the sector you want to invest in, following your fundamental analysis, then you look for an ETF that would help you achieve that goal. And like I said, we already discussed about things like synthetic ETF, inverse ETFs, the pros and cons. If you want a traditional ETF, if you want a synthetic ETF, you have to be careful which one you buy. So again, like I said, that's actually what the theme of this month of the platform is. But again, this is just an example I put on the platform, because the ETF I bought yesterday or the day before, it was an ETF tracking the pharmaceutical and biotech industry. So the homework first is to find out about the pharmaceutical and biotech industry. So that's what I did first. You know, I first analyzed that industry, you know, talked about the industry, what was going on about the industry. And then, of course, we all know with COVID and the vaccines coming out, I chose this ETF. Again, this is a physical ETF. Actually, I can just click on that link. That's a physical ETF because you can see the companies it's tracking within that ETF. And because some of the companies there, like especially Moderna, because Moderna is one of those companies that has the COVID-19 vaccine too. Apart from this other biotech companies, Gilead is another very reputable company. So they've got some very good biotech companies here that is tracking with this ETF. So that is why I chose this ETF and I bought it. So like I said, you know, it's not, when it comes to ETFs, it's not you looking at ETFs first and working backwards. It's first deciding what country, what sector. You analyze the country and sector first. And then when you're happy with your analysis and you're now sure you want to invest in that country or that sector, then you look for an ETF that tracks that sector. And then when you now find the ETF, then this is what we discussed at the beginning of this presentation. Is it a physical ETF or is it a synthetic ETF? Is it swaps? This one is because it's a US based ETF. That's why all these details are not they're not available. But obviously, if you go to an American website, you can get most of these details. But like I said, the other way you can find out is just looking at what they track, and you can see they track these companies. So that way I know it's a physical ETF, it's not a synthetic ETF. But I think, yes, that's the key. The analysis is more on the country and the sector you want to invest in than the ETF itself. And then, yes, when it now comes to the ETF, when you find an ETF that tracks the sector you want to track, then yes, you now want to find out, is it a physical or traditional ETF or is it a synthetic ETF? Lara, Rolls-Royce provides systems for defense and manufacturing. Yes, and they also provide nice cars. Rolls-Royce. I think Bimbola is going for all these luxurious things. Okay, I've answered your question, Ozzy, about the stop losses for 90 days. Adetola, there is an ETF on etfdb.com called Global X MSCI Nigeria ETF. Oh, interesting. Please, could you review this ETF? I don't think it's available on that. I don't think it will be available on HL. I don't think HL has anything to do with Nigeria. So yeah, I think that's another thing I must stress. There's a limit to what you can get on high-risk Lansdowne. You can't get everything you want on high-risk Lansdowne. So yeah, you know, there's only things that are listed on the major stock exchanges, which is the European, US, and London Stock Exchange you can get. If you want to get things from Afghanistan, Nigeria, Africa, Israel, you know, so some countries that are just difficult to get. So you might not be able to get everything you want on high-risk Lansdowne. So that's one thing to say. Yes, you can get quite a lot, but not everything. But yes, I think with the Nigerian ETF, the question now is, where do you get it? And that's where can you buy it? Although I think in Nigeria, it's within Nigeria itself. Within Nigeria itself, I think they're now launching some ETFs in Nigeria now that you might be able to get in Nigeria directly. But of course, you might need to open. You might need to open what they call it. You have to open a brokerage account in Nigeria. Let's see. iShares. Let's see. iShares. Let's see their holdings. Oh. Okay. No. It's not holding anything that looks like it's. That's not a. Let's look at your Global X MCI. So let's look at their holdings. Okay, that's good. So they've got Dangote, GTB, Nestle. This is actually a very good ETF. They've got a very good spread of the top companies in Nigeria. That's good. So that's one good thing. Expense ratio, yes, it's cheap enough. Oh, they do pay dividend. So Abimbola, this is an ETF that pays dividend. But the question is whether you can find it to buy now. So it's actually not a bad ETF. But like I say, yes, it's where can you now buy it? What's the problem now. But yeah, it actually looks good. I like the holding. So at least we now know this is not a synthetic ETF, because you can see it's really actually tracking these companies. But let's Google it and see. Let's put the buying. Okay, so this is the company. How to invest. So there you go. Who asked the question? Adetola?
I did, yes, yes.
Yes, so there you go. So again, this is the good thing about Google, but I don't know who this company is, but they've told you how they can invest, how you can buy global ETFs. But which company is this, by the way? Where are they? I don't even know where they are. Let's see, contact, let's see their contact. 8843, where is that? I don't know who these people are. Can't even tell which country they are, which they are. Oh, there they are. Okay. Are they who regulates them? That's the problem. Okay, but these are the things you need to find out. I'll put it in the chat box for you, Adetola. But these are the sort of things you need to find. But this is a good thing about, again, knowing what you want to buy, because you can now see, once you know what you want, or once you found the ETF, you can Google where you can find it. So I think I've sort of shown you the steps. But obviously, once you now want to buy it, you need to find out about this company itself. Who regulates them? Because if you give them your money and they run away with your money, then who do you report to? Anyway, maybe you have to find out, do more research. But on the face of it, I can't really find out much about them as to which country. Okay, there we are. They're in New York.
New York.
Okay, that's a good start. So if they're in New York, they're most not. You still have to make sure that they're regulated. But it'd be very difficult for you to operate as a financial institution in New York without being regulated. But you still have to make 100% sure. But whether you can also buy it from you based, if you're not based in America, I don't know whether you can get it. So that's another thing you have to find out. But you can contact them if you're that desperate to get this ETF. Well, it looks like pleasure. Well, it looks like a very nice ETF, actually. I like it. Let me see. You've got me curious now. I wonder if they have it in Nigeria. Buying ETFs in Nigeria. That's a very good ETF. Okay, something I'm out to check out myself. If I can get that in Nigeria, that would be a good one to buy. Anyway, let's leave that for later. Okay, let's go back to the question box. So this is from Aussie. So do you also swing trade on stocks in your investment account? Oh, like I said, don't forget, this goes back to the basics. Trading is different from investing. And I only buy stocks for long-term investing. So I don't trade on stocks. I buy stocks for the long-term investing. So when I buy stocks, I'm looking to hold them for a long time. I don't trade stocks. So when it comes to trading, I only trade commodities and currencies and indices on the MT4 platform. When it comes to Hargreaves Lansdown, I only invest long-term in my Hargreaves Lansdown accounts. It's only long-term. And so I might hold on to my stocks or my ETFs or my funds for 5, 6, 7, 10 years because it's long-term investing. So I think I have that clear distinction. So I don't mix those two things up. When I'm on the MT4 platform, I'm trading. When I'm on the Hargreaves Lansdown platform, I'm investing long-term, period. So whatever I have in my Hargreaves Lansdown account, I have a long-term view on them. So there's no ifs, buts, or maybes. Bola, what do you think of trading 212 platform? I was told they don't charge commissions, no fees. I have no idea. I've never used them. I know about them. How good, bad, indifferent, I don't know. I have zero experience with trading 212 platform. I know it's there, but obviously I can't advise on something I've never used. So I have no idea. Uzo, a lot of the missing information on ETFs, especially like the BTEK, can be found in their fact sheets. Okay, good. Quite long and laborious. But makes for interesting bedtime reads. Yes, you have to read it. So yeah, you do have to read all that. Like I said, it's just like we said earlier with Bola and Abimbola that, you know, if you're not sure about something, don't buy it. So if you're going to buy something, the more information you can get, the better. And you shouldn't shy away from the hard work of reading the information so you're comfortable with what you're buying. Okay. Since one is investing over the long term, is it still necessary to set the stop loss and take profit? Yes, for stocks and shares, I do, because again, as we all know, the market can crash with stocks. There's nothing like, with stocks and shares, there's nothing like buy and hold forever. Like I think I shared with you guys a while ago, where even the great Warren Buffett, he had to dump his American Airlines shares. He had to sell them because, you know, it wasn't doing well. So I think when it comes to stocks and shares, especially stocks and shares, with ETFs and index funds, and yes, I don't worry too much about ETFs and index funds, but for individual stocks and shares, you know, I do, you know, yes, I don't want to have a 100% profit go down to zero. That would be very painful. And that can happen with individual stocks and shares, because companies can go into trouble. Something can happen overnight in a company. They can go bust. All sorts can happen. And then you will see a 200% profit go down to zero. So yeah, I don't mess around with stocks and shares. I do set stops, especially when they are profitable. I do set a stop loss to at least lock in profit. And again, when I first buy the stock, if I buy a stock and I see it's falling a bit rapidly, I will set my 50% stop loss, so that at least my loss doesn't go beyond 50%. So yeah, one has to be very careful when you're investing, even for the long term, with individual stocks and shares. With index funds, yes, you can just do your dollar cost averaging and close your eyes. But don't close your eyes with individual stocks. You can see a 200% profit be wiped out. If you, especially if you're not going to be checking, and if you're not going to be checking your stocks every day, which you shouldn't be doing in your long-term investment, then you want to at least set that, have those safety guards, so you don't check your account maybe in a month's time and find that you've been wiped out. So again, yes, you always have to remember that stock share and stock value can go up and down. All sorts can happen. So yeah, this is why you have those stops and limits in place to at least protect yourself from all sorts of crazy things that can happen in the stock market. But that's for individual stocks and shares. Yumbo, I like what you said, Yumbo. You said I once sold a stock because it dropped 25% in value a few months ago, but it's back up, and past that point now, it can go either way. Now, this is very, very important, Yumbo, and I'm happy you brought that up. This is why it's very important to have a plan of how you want to treat your investments. Your investments shouldn't be treated in an emotional way. You shouldn't say, okay, because something happened once, you're going to change or you're going to do things in a random way. So it's very important to not, number one, to take emotion out of your investing, and number two, to have a clear plan. And I think you all know when I discussed with all of you during the course about my investing, I told you that once I buy a stock, I am happy to lose 50% once I bought it. If the stock does not drop by 50%, I will leave it alone. So I am clear. If it does drop 50%, I'm going to sell it. I don't care what has happened in the past or what could happen in the future. I don't care if I sell it at 50% and then it shoots up to 200%. I will not change my plan. So that's the key. The key is to have a clear way you invest and what you do. And like I showed you guys already, my own plan is clear in my own head. If I buy a stock today, if it drops 50%, I'm selling it, period. There's no emotion involved. I don't care what has happened in the past. If it doesn't drop 50%, if it drops 20, 30, 40, I don't care. If it does, so long as it doesn't drop 50%, I'm leaving it alone. If it goes up to 100%, like I said, I've already shown you guys, if it goes up 100%, I'll put a stop loss at the 50% profit mark. If it now drops from 100 and drops down 50% and takes me out, fine. If it goes up 150%, I will move my stop lock in at 100%. If it goes up 200%, I'll move it to 150. So I think that's the key. What I'm trying to show is that you should have that kind of a clear plan of how you want to treat your portfolio. Again, I'm giving you my own plan. You don't have to do exactly what I'm doing, but I'm saying whatever you do, be clear about what you're going to do on a regular basis before you do it. Not do things in a reactionary manner. That's what you should want to try and avoid as an investor. Because, for example, now you said you sold at 25% and it went back up. Then maybe the next stock that drops 25%, you might say, okay, I'll leave it alone. Then it drops 30%, then you say you leave it alone, then it drops 40, 50. Then you have to ask yourself, at what point are you going to sell that stock? But that decision must be made before you buy any stock, not while you're buying, well, not while not when you bought it and then you're now deciding what to do. You have to have that clear plan before you buy any stock. So like I told you, that's my own clear plan. So regardless of the stock, whether it's a stock in Nigeria, in USA, in America, in UK, in Europe, wherever I buy a stock, Ghana, wherever it is, it drops 50%, I'm selling it. If it doesn't drop 50%, I hold on to it because I'm doing it long term and I see what happens. You can also set alerts for stocks on HL. Yes, thanks for that, Barbara. Yes, you can. Please show how to set alerts for stocks. I haven't done that myself because I don't do alerts. So unfortunately, Belinda, I don't know how to do that one. So you might have to get Hagris Lasdau to show you how to set alerts. I guess the reason why I don't set alerts is because my decisions are sort of black and white. So once I've set the stop for 50%, in fact, the alert I will get is an email from Hagris Lasdau that my stop has been taken and I've realized my 50% loss or my 50% profit or whatever. But in between that, I don't want any other alerts. I don't want to be disturbed in between those events.
Dr. Remy, what you can actually do is when you go in the portfolio and you look at one of the stocks, you see buttons to the right. I'm not in my account now, so I can't say, but it's one of the buttons to the right of the stock. It's a bell. You click on that and you just follow the instructions from there. That's how to set the alert. I haven't done it myself, but I know, the feature is there.
There you go, Belinda. You can click on the bell. You can click on the bell and follow the instructions. But like I say, I too haven't used it before. So I've never used it, so I have no idea how it works. When in your portfolio, select, that's what you're talking about. Okay. Do HL trade fraction of shares? No, they don't do that. I think that's where trading 212 comes in. Trading 212 are the one that do the trade fraction of shares. I think that's one of the key features of trading 212. They do all this fractional trading. I think Robinhood does it too. But again, no, HL doesn't do fraction of shares. You either buy the whole, you buy the share, all or none. You buy everything or you buy nothing. If you want to buy fraction, you buy an ETF. It's an ETF, you get fractions of shares in ETFs and index funds. So yes, no, Hybris Lansdowne doesn't do fraction of shares. You get that with the likes of Trading 212 and Robinhood. But like I said, I have no experience with those platforms. So if you choose to use those platforms, you have to do your own due diligence, and whatever happens to you, it's your problem. Don't come back to me, because the only one I recommend is HL, because that's the one I use. I have never used Robinhood, Trading 212. Econosum has talked about Bamboo, Trove. There's so many of them out there. I mean, there are thousands of platforms now. There's thousands of brokerage firms out there. There are thousands of platforms, just like the one we just shared with you about the Nigerian ETF. So again, with all these brokers, with all these platforms, like I said, there's so many of them around there. All I would just advise is just you do your homework on them before you invest with them, because sometimes these platforms, they can close down, it can end in tears. But again, it's your money. It's your money, so you can do what you like, but make sure that whichever brokerage firm you use, make sure you know a bit about them. And again, that's the only reason why I recommend Hybris Lansdowne, because I've used it personally for over 18 years. So that's why I can confidently recommend it to people. And that's why I can't talk about platforms I've never used. I've heard about all these platforms, but I've never used them. So I can't recommend them. So that if you use them and you get into trouble, at least you can't say it's Remy that said you should go and use it. So I'll just say do your homework and check out about those platforms before you use them. And if you're happy with them, it's up to you. Oh, Adetola, you use Trading 212. Okay.
Yeah, sorry, I didn't finish it. Yeah, I was going to say I used Trading 212, and I was going to type that I compare HL, say like Waitrose or John Lewis, and Trading 212 is like Tesco or Audi. So there's a difference. So that's the way I would see them. Yeah. So you pay a premium for getting the best, but Trading 212 does what it says on the tin. Just about. Yeah, you don't pay commission, you can buy fractional shares. And they are regulated by the FC, whatever that, whatever it is, FCA, is it that? I don't remember.
No, yeah, I mean, you're correct. I mean, that's why I always tell people that, just like with this one we're now seeing now about the Nigerian ETF, there are just so many brokers out there. So I wouldn't say one is better than the other. They're all equally good so long as they're regulated. So I will not knock any broker or any firm. I'm just saying that I have no experience, so I can advise on them. But yes, there's so many brokers out there. In fact, even in the UK too, you have brokers that will charge you maybe £2 per. I mean, Hybris Lansdowne charges £11.95 per transaction. I know some brokers that charge £2 or £3 per transaction. So yeah, there's so many brokers out there. You're spoiled for choice. When it comes to brokerage firms, you're spoiled for choice, really. You're spoiled for choice. So whichever one takes your fancy, you use, but just make sure you do your due diligence on them. Make sure that they're reputable, regulated, licensed, and you take your chances. I think that's what I love about investing, because the bottom line is that it's your money. Which brokerage firm you use, which company you invest in, which index fund you invest in, which ETF you invest in, is all down to you. You have to do your due diligence on all that. You take your chances. You make your money, you enjoy it. If you lose your money, you take the hit. Okay, any more questions? I think we're now going into brokerage territory, which means that we've run out of questions. Okay, good. So there are no questions. We'll catch up on the platform. The recording of this session will be posted on the platform once it's processed. And then, like I said, we'll discuss the rest and take questions and comments as usual on the platform. So I wish you all a wonderful evening.